If you let a room to a lodger, you may already know about the £7,500 tax-free rent-a-room limit. A less obvious point is that rent-a-room income can count towards a completely different threshold, the one that decides whether you have to use making tax digital. Here's the surprising part. You might only pay tax on a small slice of that income, but the full amount can still push you over the making tax digital threshold. And later, I'll show you a second twist. Even if your rent-a-room income never pushes you into making tax digital in the first place, there's a specific case where you might still have to keep digital records of it anyway, straight from HMRC's own guidance. So let's work out exactly when your rent-a-room income counts and when it doesn't. Welcome back to Money Under the Microscope, helping you make finance clear. I've worked as a financial advisor since 2016 and I'm a chartered financial planner. This is a good example of two rules that sound related, working in completely different ways. Let's start with the scheme itself. If you let a furnished room in your own home, to a lodger say, you can earn up to £7,500 a year completely tax-free. That's the current rent-a-room limit. The scheme can cover some qualifying guest house or bed and breakfast income too, but today's example is an ordinary lodger. Your gross receipts include the rent itself plus anything you're paid for meals, cleaning or laundry. If someone else also receives income from letting accommodation in the same property, the limit is £3,750 for each of you. Stay at or below your applicable limit and the income is automatically exempt. Nothing to declare, nothing to pay, unless you choose to opt out, for example to claim a loss. Go over the limit and you've got two ways to pay tax. Method A, tax on your actual profit, total receipts, minus allowable expenses and any capital allowances, that's the default. Or method B, tax on your gross receipts minus your applicable limit, no expenses or capital allowances deducted. You compare both and choose the method that works best for you. Now, here's where it gets interesting. Making tax digital has its own separate threshold, based on your qualifying income, and that's your income before expenses, not your profit. If your rent-a-room receipts stay within your applicable £7,500 or £3,750 limit, and you don't have to report them, they don't count towards that threshold at all. But once you go over the limit, it's normally the full gross receipts that count, not just the slice you're actually taxed on. Tax relief and the making tax digital test are doing two completely different jobs. Here's a worked example. Say your gross rent-a-room receipts are £9,000 for the year. Under method B, only £1,500 of the lodger income is taxable, £9,000 minus £7,500, but all £9,000 normally counts towards making tax digital threshold. Now, add one other rental property, earning £22,000 gross. Your qualifying income is £9,000 plus £22,000, £31,000. That's over the £30,000 threshold for the 25-26 tax year. So assuming a full year, sole ownership and no exemption, you'd normally need to start using making tax digital from the 6th of April 2027, even though only £1,500 of the lodger income is actually taxable. Guys, just a quick interruption. If this cleared something up, do hit the subscribe button. I regularly break down easy to miss UK tax and personal finance rules here on Money Under the Microscope. Right, let's get back to the video. Even if you were below the first £50,000 threshold, this still matters because the threshold is falling. The first group, 2024 to 2025 income over £50,000, should already be using making tax digital from the 6th of April 2026. The next group is 2025 to 26 income over £30,000, starting the 6th of April 27. After that, it's 2026-27 income over £20,000 from the 6th of April 2028. Combine a rent-a-room letting with another rental property or a side business, and HMRC adds those qualifying amounts together. That can take you over the lower thresholds even when each source looks modest on its own. So how do you check a straightforward full year case? 3 steps. 1. Add up your share of your gross property income, your rent-a-room receipts in full if they're over your limit or if you've elected out of the exemption. 2. Add your gross self-employment turnover, not your profit. 3. Compare that total to the threshold for that tax year using the table on the screen. If you jointly own property or your income period is shorter than 12 months, those need extra adjustments. Check HMRC's detailed qualifying income guidance and use its online Making Tax digital checker and check for yourself rather than relying only on a letter. Now, here's that second twist I promised you. Even where exempt rent-a-room receipts didn't help put you into Making Tax Digital, they can still have to be digitally recorded once you're using Making Tax Digital for your UK property business. HMRC's own example, on their 2024-25 tax return, a landlord declares £55,000 of UK property income and also has rent-a-room receipts below the exemption limit, which don't have to be declared. From 2026-27, that landlord must digitally record all of their property income, rent-a-room included. So the income that gets you into Making Tax Digital and the income you have to record once you're using it for your property business are two separate questions. So, remember this. If your rent-a-room income stays within your limit and you don't have to report it, it stays out of the calculation entirely. Go over the limit and it's normally the full amount that counts, not just what you're taxed on. I'm Money Under the Microscope, making finance clear. If this has helped, please do subscribe to the channel and tell me in the comments, does your income add up closer to the threshold than you thought? See you on the next one, guys.